Buffett's BYD playbook, what the world's greatest investors saw. Buffett's $9 billion secret that Wall Street missed. Most people think Warren Buffett made his fortune buying Coca-Cola, Apple, or boring insurance companies. But in 2008, right in the middle of the global financial crisis, he wrote a $230 million check to a little-known Chinese car and battery maker called BYD. A tiny bet, an almost anonymous founder. 17 years later, that position turned into nearly $9 billion. $230 million transformed into $9 billion, a return of 30 times. And then Buffett sold everything. A true masterstroke. This video breaks down the real playbook behind one of the most impressive investments in history. I'm going to show you step by step the exact system that Warren Buffett used, not just to identify a market opportunity that multiplied his capital by 30 times in 17 years, but also to know the right moment to exit with maximum profit and minimum risk. We're going way beyond the what he did. We're going to understand the how and the why, and how you can apply this to find your own BYD. If you already understand the basics about risk, return, and long-term investing, you're going to extract a lot of value here. At the end of the day, the question is, would you know to manage that investment from the 1st to the 17th year without letting your emotions sabotage the power of compounding over the long term? Quick heads up, this content's for folks who already know the basics of the market game, so buckle up. Picture September 2008. The financial world is collapsing. Lehman Brothers has just gone bankrupt. Credit markets are frozen. Investors are selling everything and running for cover. It's the worst possible time to risk money. The safest thing to do is keep cash and wait. While the world was collapsing, banks failing, markets crashing, investors panicking, Buffett was doing the opposite. Quietly, through Mid-American Energy, now Berkshire Hathaway Energy, he signed a check for $230 million. The destination of that money? A Chinese electric car and battery company that almost nobody in the West knew, BYD. It was 225 million shares, purchased at just 8 Hong Kong dollars each, equivalent to 10% of the company at the time. While the market fled from risk, Buffett ran toward it, not on impulse, but because he saw something that almost nobody else saw. Charlie Munger had met Wang Chuanfu, the founder, and came back obsessed. "This guy is a mixture of Edison and Jack Welch," Munger said, "an inventor who knows how to build empires." While Wall Street was panicking, Buffett saw opportunity. The idea behind the investment wasn't to make quick money with quarterly profits. It was a long-term plan. In other words, it wasn't about getting the quarter right. It was about getting the entire decade right. While Wall Street was counting pennies every 3 months, Buffett was looking ahead and thinking, if the world is going to electrify, whoever dominates batteries is going to print money for years. And Wang Chuanfu wasn't just any CEO. He was an obsessive who controlled everything, from cell chemistry to the last screw in the car. Result: he doesn't just lower costs, he doubles the learning curve in his favor. Like a chef who plants the wheat, grinds the flour, bakes the bread, and sells the sandwich. You control the process, the cost, and the profit for years. Total control means total advantage. Most of Wall Street didn't care. China was considered too distant, electric vehicles too premature, and 2008 seemed like the worst timing. That's exactly why it worked. Now here's what separates the amateurs from the legends. Most people think Warren Buffett just has some magical intuition. They imagine he wakes up one morning and says, "You know what? I feel like buying a Chinese battery company today." That's complete nonsense. What I'm about to show you is the exact decision-making framework that turned a 77-year-old man into one of the richest people on the planet. This isn't luck. This isn't gut feeling. This is a systematic approach that you can learn and apply. Buffett's genius seems mystical, but it's pure system. When he looked at BYD in 2008, he ran it through the same three-pillar checklist he's used for decades. And if you understand these three pillars, really understand them, you'll start seeing opportunities that 99% of investors completely miss. 3 non-negotiable pillars that have never failed him. Pillar 1, the competitive moat. Where is the advantage that expands over time? For BYD, it was batteries, proprietary chemistry, unique manufacturing processes, and the brutal learning curve that comes with shipping millions of cells. Each battery produced made the next one cheaper and better. Pillar 2, the jockey before the horse jockey over horse. Wang Chuanfu wasn't a visionary who delegated execution. He was a builder who slept in the factory, made $1,000 decisions on Tuesday and adjusted penny processes on Wednesday. Mediocre leaders build mediocre businesses. Obsessives build empires. Pillar 3, margin of safety, price matters. Buying at $8 during global panic incorporated a mountain of future errors. If the thesis worked, the return would be astronomical. If not, the loss would be a scratch. That's the beauty of asymmetry. Buffett is willing to wait years while others demand instant proof. The market pays a premium for certainty and speed. Compounding pays a premium for patience. Charlie Munger always preached, invert, always invert. Instead of asking what can go right, just ask, how does this fail? If the only answer is, competitors can't catch up fast enough, and the founder will reinvest advantages into more advantages, you might have a winner. This was not a bet on China as a macro theme. It was a bet on controllable microeconomics, unit costs, yields, and a founder's culture. When microeconomics are relentlessly favorable, macro volatility becomes survivable. While Western headlines focused on Tesla, electric vehicle prototypes, and promises, BYD did the silent and brutal work of real scale. They didn't just assemble cars, they built the entire ecosystem. Batteries, manufactured internally. Motors, own design and production. Power electronics, controlled, reusable platforms, dominated. Vertical integration isn't religion, it's surgery. BYD cut supplier margins and brought them in-house, reduced fatal dependencies and accelerated innovation cycles from months to weeks. In the early 2020s, while the world debated whether electric cars had a future, BYD was already producing hybrids, pure electrics, buses and storage systems. Volume isn't everything, but in batteries, it is everything. Each volume doubling cut costs and improved performance. And as volume accumulated, so did the value of patience. Investors addicted to quarterly dopamine sold at the first volatility. Buffett held on. Compounding did the heavy lifting. All he needed to do was not interfere. From 2008 to 2021, this do-nothing strategy transformed 230 million into billions. The power of time working in your favor. If the first half of the story is about finding a symmetry, the second half is about recognizing when it disappears. In 2023, the signals started flashing. Fierce price competition, margins being squeezed, inventories growing, and announcements of new capacity exceeding demand. The easy growth was over. What remained was a war for market share, often a tax on profits. Howard Marks always said, "You don't need a crystal ball. You need sensitivity to where we are in the cycle." In electric cars, this meant watching when the magic of economies of scale turned into brutal commodity. BYD was still the leader, but returns on incremental capital were worse than in the past. For a long-term investor, this is the moment to separate love from logic. Buffett didn't sell because the company got bad. He sold because the probabilities changed. The thesis that paid for 17 years might not pay for the next 10. And there's more: geopolitical risks, sanctions, trade barriers, capital controls. For Berkshire, with trillions under management, exposures that are hard to measure become portfolio traps. Better to harvest the fruits of victory before fragility appears in the headlines. Now let's get to what matters, how you apply this. Here's the 5-step protocol. Step 1, founder scorecard. Evaluate iteration speed, capital discipline, team stability, and willingness to cannibalize their own business. If the grade is mediocre, run. The world is too competitive for mediocre leaders. Step 2, identify cost curves. Look for where costs fall as volume increases. Batteries, software, logistics networks, anything with a learning rate. If you can't map the curve, the advantage might just be narrative. Step 3, buy with embedded pessimism. Purchase when headlines are hostile and liquidity is scarce, not for contrarian style, but because you want forgiveness built into your entry point. Pessimistic prices forgive future errors. Step 4, size to survive. Small position, giant patience. If a 50% drop would change your life or your sleep, the position is too big. Asymmetry only works if you can handle the volatility. Step 5, predefine exit triggers. Write them down before buying. Margin compression for X quarters, irrational price wars, unacceptable regulatory risk, or better opportunity cost. If triggered, execute without drama. The errors that kill fortunes and how to avoid them. Let's be brutally honest about what destroys even the best opportunities. Deadly error for 1, marrying the position. Love doesn't make the cycle love you back. The BYD of 2008 was brilliant. The BYD of 2025 was different. Context changes. You need to change too. Deadly error 2, oversizing the right bet. If you can't sleep through the volatility, your advantage is imaginary. Position sizing is everything. Deadly error 3, confusing narrative with reality. Revenue that depends on subsidies isn't the same as sustainable margin. Unit economics matter more than pretty stories. Deadly error 4, ignoring opportunity cost. Even great businesses can be wrong positions if something better appears. Dead capital is dead capital. Deadly error 5, selling just because it went up. Past gains aren't an investment thesis. Future expected return is. The harsh truth: most investors find their BYD and destroy it with impatience, greed, or fear. Buffett's system works, but only if you have the discipline to follow it for years. So what's your BYD? And more importantly, do you have the emotional coldness to transform 230 million into 9 billion without sabotaging the process halfway through? The opportunity is out there. The question is, are you prepared to recognize it and execute it like a master? If this playbook is helping you think clearer, like the video so more investors find it, subscribe to Rich Mind Lab. We break down the real frameworks that build wealth, not noise. And share this with a friend who confuses luck with skill. They may hate you now, but they will thank you in 5 years.